Australians truly love using trusts. According to the latest statistics from the Tax Office, as of 2022, there are a total of 950,000 trusts in Australia, which is close to the number of companies. If you add the special category of super funds, which is also a kind of trust, the number actually surpasses that of companies. Types of trusts in Australia include fixed trusts, unit trusts, hybrid trusts, charitable trusts, bare trusts, testamentary trusts, real estate investment trusts, self-managed super funds. Yes, self-managed super funds are also a kind of trust. Among many types of trusts, Australians' favorite is the Discretionary Trust, also known as the Family Trust. And this is the focus of our video today. What are the 5 main reasons Australians love using family trusts? Is a family trust suitable for holding investment properties? Hi there, my name is Alex. Welcome to my channel where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Before we dive deeper into our discussion, let's first understand the concept of trust. What exactly is a trust? In Australia, there are 4 types of business entities: sole trader, partnership, company, and trust. All these 4 types can be operated as businesses. So in a way, a trust is somewhat similar to a company. However, their operational rules, accounting standards, and regulations are very, very different. A trust is essentially a fiduciary relationship between the person managing the assets within the trust and those benefiting from its returns. The initiator of the trust, also called the settlor, establishes this fiduciary relationship and its rules, formalizing it with a contract known as the trust deed. This deed is similar to a company's constitution drafted when setting it up in Australia. The settlor of a trust is just like the founder of a company. Under the framework of the trust deed, the trust comes into existence. In reality, the settlor is often an accountant or solicitor. Accountants optimize the trust structure for tax purposes, while solicitors enhance it for asset protection. You choose who will assist you, depending on the purpose of establishing the trust. When we help Vision members establish a trust, both these aspects are considered. A trust, in a sense, functions like a company. Once a company is formed without management or assets, it's just a shell, and that's not feasible. Then an appointor, equivalent to a company's chairman, must appoint a CEO to manage the company's assets and operations. This CEO is the trustee. The trustee decides how the trust operates, where to invest, and how to distribute the profits. The assets in the trust do not belong to the CEO, but belong to the trust. These assets can include stocks, cash, real estate, and more. The profits generated from the trust operation are distributed to the beneficiary. A beneficiary can be an adult, child, or even a company. The trustee can be an individual or a company having complete control over how much each beneficiary receives. And then the entire relationship of the trust is established. The trustee manages the trust, making and dividing the profits, while the beneficiary merely enjoys the profits. Depending on the purpose of the trust, these 4 roles can be filled by 4 different individuals or even just one person. If you wish, all 4 roles can be held by you. A more typical arrangement, however, has an accountant as the settlor, the appointor as a trustworthy individual like one's parents or close friends, the trustee as a company with oneself as the director, and family members as beneficiaries. According to ATO, 80% of trusts in Australia are family trusts, indicating their popularity. So why are family trusts so sought after in Australia? Well, there are 5 main reasons. Reason number 1, privacy. If you don't want others to know who truly owns an asset, using a trust is the solution. The trustee can control the operation and profit distribution of the trust, but they don't own the assets within the trust. This is because the legal owner of the trust assets is the trust itself. For instance, if you want to purchase a property without your name appearing on the contract, you can achieve this through a trust. Let's say your name is Mr. X and you are the trustee. When buying the property, the buyer section will write Mr. X as trustee for ABC Trust. If you don't want the name Mr. X to appear on the contract, you can act as the settlor and have someone else be the trustee. Hence, the deed will display Mr. Y as trustee for ABC Trust, or even establish the company to act as the trustee, resulting in XYZ Pty Ltd as trustee for ABC Trust. If there are multiple directors in the company, it becomes very challenging to know who exactly controls the trust. To outsiders, it's too hard to find out who ultimately holds control over the assets in the trust. Thus, discreetly wealthy people often use intricate trust structures to hide their identities, which also plays a pivotal role in asset protection, leading us to the second point. Reason number 2, asset protection. Imagine you've spent a lot of money buying your son a house, a car, and a bunch of stocks, and give him some cash. Later, your son falls for a gold digger. If the relationship ends, part of the assets under your son's name will likely be taken away, as the intention of the gold digger might be to target his wealth. By establishing a family trust and appointing your son as the director of the trustee company and beneficiary of the trust, it is very hard for someone to take the asset. That's because he doesn't own the asset, yet can control and enjoy the benefits they generate. It's like building a robust firewall for assets, making it incredibly hard for others to steal. Apart from gold digger scenarios, trust can also safeguard against unfilial children who might kick parents out after receiving your property, as well as situations like company or personal bankruptcy, professional malpractice, creditor claims, and divorce. Depending on the trust structure, timing, and mode of operation, it can offer varying levels of asset protection. This is especially applicable for high-risk professionals such as lawyers, doctors, executives of listed companies, and business owners. Reason number 3, less compliance. The third reason is that trusts have lower compliance requirements than companies. Operating a company requires an annual review with ASIC, like renewing a car registration and yearly report submissions. Once a company reaches a certain size, an independent third-party audit is required. Family trusts, however, don't have these requirements. They don't need annual reviews, annual reports, or independent audits, regardless of the size of assets in the trust. So they're easier and simpler to manage. Reason number 4, flexibility. Of all trust structures, family trusts are the most flexible. They can achieve what you've thought of and even what you haven't. For example, as the settlor, if you aren't satisfied with the trust operation, you can replace the trustee at any time, like switching from the eldest son to the second son. Similarly, beneficiaries can be added, removed, or changed at any time, and their income distribution can be adjusted every year. Let's say in your twilight years and being wealthy, you wish for the second and third generation of your family to be taken care of. The trust can stipulate that any descendant with disabilities or severe illnesses can automatically become a beneficiary, financially supported by the family trust. Or if you wish for your descendants to succeed, you can specify in the trust deed that the second or third generation can only become beneficiaries if they start a business with revenue exceeding $1 million a year, or perhaps if they get married and have children before 30. Yes, all these can be achieved with a family trust. Reason number 5, taxation. The fifth point, my favorite, is that family trusts are highly effective tools for tax planning. Firstly, a trust income can be distributed to the beneficiary with the lowest income, reducing the family's overall tax rate. Let's say the husband works and earns $200,000 annually, while the wife stays at home without any income. If the trust profits $18,000 a year, you can opt to distribute the entire income to the wife, avoiding income tax since her income falls below the tax threshold. This strategy would save $8,100 compared to distributing it all to the husband, whose marginal tax rate is 45%. This strategy is commonly used in family trusts. The more beneficiaries there are, the greater its effect, and the overall tax rate becomes even lower as more people fall within a lower tax bracket. Secondly, if both husband and wife have an income of $200,000 and are taxed at the highest rate, you can introduce a newly established company as the beneficiary. Distribute the trust income to this company and tax it at the company's flat rate at 25%. To take it a step further, you can distribute the post-tax income of the company to its shareholders and use the franking credit system to reduce the overall tax rate. Thirdly, assets held by the trust can enjoy a 50% capital gain tax discount, similar to individuals. You can separate cash flow income from capital gains income and distribute them to different beneficiaries. For instance, if one beneficiary had capital losses in previous years, it can offset against capital gains, reducing the CGT. Trusts offer high flexibility in tax planning. And that sums up the 5 main reasons Australians prefer using family trusts. 1, they can maintain the privacy of asset owners. 2, they establish a firewall to safeguard assets from losses. 3, they aren't burdened with complex compliance requirements. 4, they offer strong flexibility, allowing for adjustments for trustees and beneficiaries. 5, they are excellent tools for tax planning. So, what are the advantages and disadvantages of using family trusts in Australian property investment? Many people who have previously bought investment properties under their names would consider owning them through family trusts. But is it beneficial to purchase properties using a trust? I've summarized 3 advantages and 3 disadvantages for you. Advantages number 1, Buying properties with a family trust can achieve asset protection and prevent debt collection. For instance, if you, as a trustee or as the director of a trustee company, get sued and are demanded financial compensation, there's a high possibility that the assets in the trust won't be touched. For this reason, developers and builders in Australia are particularly reluctant to sell properties to family trusts, because if the buyer defaults after the house is built, it's challenging for developers and builders to recover their losses. In the context of second-hand properties, purchasing with a family trust usually faces no opposition from sellers because it's a straightforward transaction of payment for the property. Number 2, family trusts can reduce tax liabilities on property investment returns through tax structures and can utilize a 50% discount on capital gain tax. Number 3, it can increase loan amount through structural operations, providing significant help to investors who have difficulty securing loans. Disadvantages. Number 1, using a family trust is not free. Setting up a family trust requires a fee, and maintaining it incurs an annual cost. Number 2, family trusts can't utilize negative gearing. Any current loss from the property can't offset income. Number 3, for couples who only have salary income with a simple family structure, it's not certain whether a family trust is beneficial. Seeking advice from professionals is essential in this case. What we can see is that family trust itself isn't the core issue. The issue is what you aim to achieve. Then the next question is whether or not using a family trust will help you reach that goal. To address this, you need to consider 5 factors. 1, investment targets and strategies. 2, tax planning. 3, legal matters. 4, mortgages. And 5, wealth planning. Vision membership of Oz Property Strategy can provide one-stop solution to these 5 concerns. Contact us if you're looking to find a comprehensive property investment solution via email or phone in the video description below. If you've made it this far, please give me a thumbs up, subscribe, and share this video with your friends. Turn on the notification bell to watch new weekly videos and follow me on social media at RealCoachAlex. I'll see you in our next video. Have a good one. Bye.